I've analyzed the latest reports on Bitcoin's transformation into a reserve asset. The shift from speculation to a strategic, regulated component of the global financial system is the defining story of 2025 and beyond. The information here is presented as a flowing narrative, distilling key developments from authentic sources, suitable for a detailed discussion or video script. I'll use a timeline and bullet points for clarity, as they are mobile-friendly and helpful for structuring complex developments. The regulatory foundation, from gray zone to codified law. The journey of Bitcoin as a reserve asset began not with a purchase, but with a policy revolution that provided the essential sovereign air cover for institutions to participate. The U.S. takes a strategic lead, March 2025. The most significant event was the signing of an executive order by President Donald Trump to establish a U.S. Strategic Bitcoin Reserve, SBR. This action formally reclassified approximately 200,000 seized Bitcoins, already owned by the U.S. government and making it the largest known state holder, from assets to be liquidated into permanent national reserve assets. While initially funded by existing holdings, the order left the door open for future, budget-neutral acquisition strategies. A separate digital asset stockpile was also created for other cryptocurrencies, clearing the path for Wall Street. Just days before the SBR announcement, a major barrier fell. The repeal of the SEC's Staff Accounting Bulletin 121, SAB 121, and its replacement with a risk-based framework finally allowed major banks and custodians to hold digital assets for clients without prohibitive balance sheet treatment, unlocking traditional finance. Legislative milestones. The momentum continued with the passage of the Genius Act in July 2025, which created a clear federal framework for stablecoin issuance. This, coupled with a significant shift in the SEC's leadership and approach from regulation by enforcement to clearer guidance, drastically reduced legal uncertainty for U.S. firms. A global regulatory wave. This U.S. policy shift acted as a global catalyst. The European Union's markets in crypto assets (MiCA) regulation took full effect, creating a harmonized rulebook across the bloc. Jurisdictions like Dubai (VARA), Singapore (MAS), Brazil, and the UK advanced or implemented comprehensive licensing regimes, moving crypto from a regulatory gray zone into established financial structures worldwide. The new reserve holders, sovereigns, and corporates. With regulatory infrastructure in place, the who of Bitcoin ownership expanded dramatically beyond retail traders and crypto-native funds. The MicroStrategy playbook goes mainstream. The MicroStrategy playbook, where a public company converts cash reserves into Bitcoin, stopped being an anomaly and became a new corporate standard. Companies from the US to Japan began reporting BTC yield as a key performance indicator, using debt and equity raises to accumulate Bitcoin as a primary treasury asset. Some, like Bitmine immersion technologies, evolved further into active treasuries, holding and staking assets like Ethereum to generate yield directly from the protocol. Sovereign interest beyond the US. The US SBR influenced global state-level strategy. Texas created its own strategic Bitcoin reserve by law in 2025. New Hampshire passed a bill allowing its state treasury to invest in digital assets with a market cap over $500 billion, effectively only Bitcoin at the time. Pakistan announced plans to allocate surplus electricity to state-backed Bitcoin mining, while Bhutan continued to expand its sovereign mining operations using hydroelectric power. In a landmark pilot, the Czech National Bank executed a small Bitcoin purchase to evaluate operational and risk considerations, placing it on a developed market central bank's balance sheet for the first time. The ETF gateway. Perhaps the most powerful channel for institutional capital has been the Spot Bitcoin Exchange Traded, ETF. By the end of 2025, these products held over 800,000 BTC, with BlackRock's IBIT becoming the fastest-growing ETF in history. They provided a familiar, regulated vehicle for pension funds, wealth managers, and sovereign wealth funds to gain exposure without touching the underlying technology. The why. investment thesis and market evolution. The fundamental reasons for this institutional embrace have crystallized. A hedge against fiat debasement, a core thesis, especially among institutions, is Bitcoin's role as digital gold, a scarce, non-sovereign store of value in an era of high public debt and concerns over currency debasement. Its programmatic, transparent supply schedule, the 20th millionth Bitcoin will be mined in March 2026, contrasts with unpredictable fiat monetary policy. Portfolio diversification. Institutions now view Bitcoin as a legitimate strategic allocation to improve risk-adjusted returns, moving it from a speculative bet to a part of multi-asset portfolios. Maturing market dynamics. The nature of the market itself is changing. Analysts note that Bitcoin's volatility has been trending downward over the past 5 years. Furthermore, the current price cycle has been characterized by steady institutional buying via ETFs, rather than the dramatic retail-driven surges of past cycles, suggesting a more stable foundation.
Looking ahead to 2026, velocity and convergence. The industry views 2025 as the year of building regulatory and strategic infrastructure. The focus for 2026 is on velocity, putting these assets and frameworks to work. Key catalysts to watch. The Clarity Act. Passage of this pending U.S. market structure legislation is considered a top potential catalyst for 2026, as it would finally delineate regulatory jurisdiction between the SEC and CFTC, removing a major lingering uncertainty. Strategic Bitcoin reserve purchases. While the SBR currently holds seized coins, markets are watching for any move by the U.S. Treasury to make active budget-neutral purchases, which could trigger a global Bitcoin arms race. And continued institutional on-ramping. The process of incorporating crypto into mainstream model portfolios is still in early stages. Grayscale estimates less than 0.5% of U.S. advised wealth is allocated to crypto, indicating vast room for growth as due diligence processes conclude. Converging trends. The future lies in the fusion of traditional finance, TradFi, and decentralized finance, DeFi. Expect more tokenization of real-world assets like bonds and funds on blockchain, the rise of institutional-grade DeFi for lending and yield, and the maturation of the stablecoin standard for global payments and settlement. In summary, Bitcoin's incorporation into reserve assets is not a speculative trend, but a structural shift. It is built on a foundation of formal U.S. policy recognition, global regulatory clarity, and its adoption by corporate and sovereign balance sheets as a strategic hedge. The digital gold narrative is now backed by concrete action, setting the stage for Bitcoin's deeper integration into the architecture of 21st century finance. I hope this comprehensive overview provides a solid foundation for your video. If you would like to focus on a specific region's policy, the mechanics of corporate treasuries, or the data behind institutional ETF flows, I can provide more detailed information on those areas.